Does choosing to invest with your conscience mean you have to sacrifice returns? Thinking face, that's the billion-dollar question for anyone interested in socially responsible investing, or SRI. Today, we're diving into the performance of two popular players in the Canadian SRI space, Wealthsimple's North America Socially Responsible Index ETF WSRI, and the Developed Markets X North America Socially Responsible Index ETF WSRD. These aren't your typical index funds. They're built with a purpose, actively filtering out controversial sectors like fossil fuels, weapons, tobacco, and gambling. The SRI philosophy. Wealthsimple launched these proprietary ETFs to offer a more stringent screen than many existing SRI options. WSRI focuses on Canadian and U.S. equities, while WSRD gives you exposure to developed markets like Europe, Australia, and parts of Asia, without the U.S. Both exclude companies that fail gender diversity standards and those with high carbon emissions, going well beyond basic screens. But how has this commitment to doing good translated into doing well financially? WSRI, North America Performance. Let's look at WSRI. Since its inception in June 2020, this ETF has aimed to track an index of North American companies weighted by factors like quality and momentum, not just market size, all while applying those strict ethical screens. The performance has been solid, largely keeping pace with its underlying benchmark. For instance, over its first few years, WSRI has generated annualized returns that are competitive within the broader North American equity category. In the most recent year, WSRI's total return was around 11.4%, which is incredibly similar to its benchmark. This suggests that for North American exposure, the ethical screening hasn't significantly hurt returns. In fact, by excluding old economy sectors and focusing on factor-based weighting, WSRI has delivered strong growth in line with the tech-heavy, growth-oriented market environment. WSRD, Developed Markets Performance. Now, for WSRD, the Developed Markets X North America ETF. This fund is crucial for diversification, giving investors exposure to international developed economies. WSRD has similarly seen strong returns, again performing right in line with its non-North American ethical index. Its focus on European, Australian, and Asian equities provides a valuable hedge against concentration risk in the North American market. In the same recent period, WSRD's return was around 11.4%, nearly identical to its benchmark's return. The takeaway here is that you can build a diversified global portfolio, filtering out the companies you don't believe in, without sacrificing the international component of your growth strategy. The verdict: ESG doesn't mean less growth. When you look at the evidence, the performance of WSRI and WSRD makes a clear case. Socially responsible investing can be highly competitive. The long-term performance suggests that Wealthsimple's proprietary screening methodology hasn't created a massive drag on returns compared to their respective ethical benchmarks. The key is in the diversification and the strategic factor-based weighting that complements the ethical screens. If your priority is aligning your investments with your values, these ETFs show you don't have to compromise your long-term growth objectives. They are a powerful option for building wealth consciously. With that said, thanks for watching, and until next time.